let's begin with the basics. What is a journal entry? A journal entry is a formal way to record our transactions in the accounting books. Okay, it includes the date of the transactions, the particulars, accounts involved, the debit and credit amounts, and lastly, a narrations, which is a short explanations to describe the transactions. Okay, every transactions is written using the double entry systems, means one account is debited and another is credited. So, okay, here is a simple step-by-step process you can follow to prepare a journal entry. Okay, start with the step one. First, identify the transactions. You have to know what the transaction is saying. It's about paying, receiving, purchasing, selling, or incurring an expense. Okay, first identify. Okay, next step two, recognize the accounts involved. Here example, we are purchasing furniture with cash. Okay, then we are recognizing here furniture and cash. Okay, every transaction has two accounts involved. Here is furniture and other is cash. Okay, then step three is classify the accounts. We have already learned about the types of accounts. Here is also we have to classify the accounts. There are three types: personal account, real account, nominal account. Every transactions have involved two accounts, and the two accounts are and those two accounts fall in these three types of accounts. Okay, personal account, real account, and nominal account. Okay, uh, let's see step four. Step 4 is all about the applying the golden rules. Okay, personal account, we already know, debit the receiver, credit the giver. Real account, debit what comes in and credit what goes out. Nominal account, debit all expenses and losses, credit all incomes and gains. Okay, and here step 5, decide what to debit and what to credit. Okay, we know there is two accounts involved in every transaction, so we have to decide which account is debit and which we have to create. Okay, classifications and rules we have to apply to find out debit or credit. Okay, lastly, step 6, write the entry with the narrations. Lastly, we have to write the narrations to describe the transactions. Okay, okay, let's see some practical examples of trial balance. Here, example first, started business with cash rupees 1 lakh. Okay, first we have to step 1, find out the transactions, what is about started business. Okay, step 2, we have to recognize two accounts. Okay, here is capital account and cash account. Now we have to step 3, we have to know these two accounts. Now we have to find out uh, in which types of accounts these two accounts fall. Here, capital is in personal account and cash is real account. Okay. Now step 4, capital giver here. So it is great and cash comes in. So we debit it. Okay. See journal entry of this example. Here there is date, particulars, debit and credit. Now we have to write date of the transactions, and then here cash, debit side, cash account debit. Okay, rupees 1 lakh, and then two capital account in credit side. Here is amount 1 lakh rupees, and this is the narrations of transactions to describe the transactions. Okay, uh, see example second, bought furniture for rupees 5,000 in cash. Okay, here is also furniture account and cash account is involved in these transactions. Okay, so furniture is a real account. So yeah, furniture is coming into our business, so we debit it, and cash is real account and it is going out, so we create it. And see here is same types of journal entry like this, same furniture account debit and to cash account, create. Okay, and here it is narrations of the transactions. Okay, before we wrap up, here are some quick tips. Always identify the two accounts first from the transactions, and then never guess. Okay, use golden rules. Then double check your debits and credits. Okay, and then don't forget narrations. It's important in exams and real world. Okay, and lastly, keep practicing with different types of transactions. Okay, it helps you to understand better. Okay, let's start with the basics. What is a ledger? A ledger is the principal books of accounts. Okay, it is where all transactions from the journal are transferred. Okay, in simpler words, the journal is where transactions are first recorded, and the ledger is where transactions are grouped and organized by account. Each account, like cash, sales, capital, rent, get its own page in ledger. Okay, this helps in tracking the individual balance of each account easily. Okay, the ledger format looks like a big T, so it is often called a T account. Okay, here is the format. We can call it left side debit. Okay, and right side credit side. Okay, we have to write account's name on the upper part of the account, and then this side debit side date, particulars, journal folio, amount, and same on this side credit side. Okay, we'll understand this much better with practical examples coming up shortly. Okay. Okay, when posting from journal to ledger, keep these rules in mind. Okay, every journal entry affects two ledger accounts, one on the debit side and one on the credit side. Second, in the ledger you mention the opposite account name from the journal entry. Okay, last, you must post to both accounts involved. Okay, for example, see here, if in the journal you wrote cash account debit 10,000, 10,000 to capital account 10,000. Okay, uh, then in the ledger we write it like uh, in cash account you post to capital account debit side. Okay, and in capital account post by cash account credit side. Okay. Okay, let's see some practical examples of ledger posting. First, started business with cash, rupees 10,000. Here, the journal entry of these transactions will be cash account, debit to capital account. Okay, and the ledger posting of these transactions will be like cash account. This is the ledger account's name. Okay, to capital account, debit side, and ledger accounts of capital account will be like in credit side by cash account here. Okay, like posting. Okay, see an example. Here bought furniture for rupees 2,000 in cash. Okay, journal entry of this transaction will be furniture account debit to cash account. Okay, and the ledger posting will be like this. Okay, furniture account to cash account by furniture account. Okay, opposite side. Okay. Okay, let's see how we can balance the ledger account. Okay, see, first add up both debit and credit side. Let's see, add both debit and credit side. Okay, and then find the difference. We have to find the difference between debit side amount and credit side amount. Okay, and then put the difference on the shorter side. Okay, as balance CD, which is also called as carried down. Okay, here see balance CD. Okay, we have to write max total amount. Okay, in the total amount, uh, and the total amount will be same on both side. Okay, and C plus. Next period as balance BD, borrow down the same amount which have written, which we have written on to balance CD, which also have to write it same amount on here. Okay, by balance BD. Here see, uh balance amount used to prepare the trial balance. Okay. Okay, let's see some common mistakes we have to avoid. See, first, posting only one side, forgetting the second account. No, it's wrong. Okay. uh, then not writing the opposite account name. Okay. Third, mixing up debit and credit side. Okay. Lastly, forgetting to balance the accounts. Okay. Let's start with the basics. What is a trial balance? Okay. A trial balance is a statement that shows the closing balances of all ledger accounts listed on the debit and credit columns. Trial balance prepared at the end of an accounting period to check its mathematical accuracy, okay, of ledger accounts. Okay. The simple goal of trial balance is to ensure total debits amount equal to the total credits amount. Okay. Let's see the format of a trial balance. See, uh, this said symbol number, okay, account name, particulars, okay, and debit, credit, okay. This amount which is written, it is the closing balance which is calculated in a ledger account. Lastly, by balance borrow down or to balance borrow down. Okay. Lastly, we have to total the we have to total both sides of account, okay, debit side and credit side. Okay. And this have to equal. Okay. Let's understand the steps to prepare our trial balance. First step one, finalize the ledger accounts. Okay. uh, before before we prepare our trial balance, we have to balance all the ledger accounts. Okay. Then step 2, classify the balance account. It's a debit balance or a credit balance. We have to classify. Okay. See, debit debit balance will be like this: assets or expenses. Assets like cash, furniture, inventory. Okay. Expenses like rent, salary. Okay. Let's see the credit balance, which includes liabilities, income, capital. See, liabilities like creditors, loans, incomes like sales, commissions. Okay. We'd see. Step 3, uh, enter in the trial balance format. List the accounts on the credit column, debit side or a credit side. Okay. Lastly, step 4, total both columns. Total match, good to go. If not, then sure there is error in the ledger accounts. Okay. Or in trial balance. Thank you. Okay, let's see a practical example of trial balance. Suppose these are the closing balances from the ledger. Okay. See, here are the format of trial balance, and by using the golden rules of accounting, we have included all the accounts. Okay. And lastly, we have total the debit side and credit side, but we have identified some errors, difference of 2000. Okay. Here trial balance is not matching. Okay. That's why we use trial balance to ensure the arithmetical corrections. Okay. Okay, here is some common errors and tips. Okay. See, copying wrong balances from the ledger. Okay. Posting an account in the wrong column. Okay. Arithmetic errors in totaling. Okay. And lastly, forgetting to include some accounts, which can make errors while calculating the debit side and credit side amount. Okay, we have to know the importance of trial balance because it ensures the ledger arithmetically correct. Okay. It helps to prepare final accounts, trading, PL, balance sheet. Okay. It highlights the errors before final reporting. Okay. Okay. Let's start with the basics. What is trading and profit and loss account? Okay. The trading account and profit and loss account are parts of the final accounts of a business. It helps us to find gross profit or loss from the trading account and net profit or loss from the profit and loss account. Uh, think of them as tools to check. Tools to check. It helps to check how much you earned from the core operations and how much profit actually made after all expenses. Okay. See the format of trading account. Trading account is all about focuses on buying and selling of goods. Let's see the format. See here, trading account for the year ended, the debit side, which is also called expenses and losses, and the credit side of the trading account, which is also known as incomes and gains. Here we can first write opening stock, then purchases, and we have to less purchase returns and all direct expenses related to buying and selling of goods. uh, Here likes wages, carries, okay, and credit side sales, and less we have to less sales returns, and lastly we have to write closing stock. And note, if the credit side is bigger, you get gross profit, okay, and if the debit side is bigger, it's a gross loss. Now see the steps to prepare trading account. Okay. Step one, opening stock. This is the unsold stock at the start of the year. Okay. Unsold stock start of the year. And step two, purchase, which is in debit side. It is also included in debit side of the trading account. See total purchases made. Okay. And don't forget to subtract purchase returns. Okay. And now see step 3, direct expenses, which is also included in debit side of trading account. See, like wages, carries inwards, fuel used in productions. Okay, and see step 4, sales, which is included in credit side of trading account. Okay, all sales made during the year, and lastly subtract sales returns. Okay, and lastly see step 5, closing stock, which is also included in credit side of trading account, which is unsold stock, which is left end of the year. Now see practical example of trading account. Just suppose these accounts are opening stock rupees 5,000, purchases rupees to 20,000, sales is here given 35,000, closing stock, wages, and let's understand it by trying trading account. Here this is debit side and it is credit side of trading account, and like see opening stock, which is included in opening debit side of trading account. Opening stock, purchases, here is purchases, and which is also direct expenses, okay, related to buying and selling of goods. That's why we have a debited wages. And here sales is a revenue related to selling of goods. That's why we have credit side of trading account we have included. And lastly closing stock, which is unsold stock left at the end of the year, and we have included it. And lastly we have balanced the amount, and this is the difference. Okay, that's why we have written as gross profit. Now that we know the gross profit, okay, we move to the profit and loss account. Okay, see the profit and loss account format here. uh Here the debit side, which is also known as indirect expenses, and credit side of PL account, which is also known as incomes. See, it is all the indirect expenses like salaries, rent, printing, etc., and depreciation, advertising, etc. And in credit side, gross profit from trading account. Okay, and lastly indirect income, see commission received, interest received, etc. Okay, see if income is greater than expenses, okay, we found out net profit, and if expenses is greater than income, then we have to bear loss, net loss. Now see the steps to prepare a PL account. First, step one, bring down gross profit. Okay, this comes from the trading account and is recorded on the credit side of PL account. Okay, and then step two, add incomes like commission received, interest income, etc. Okay, etc. Step 3, C, list all indirect expenses. Okay, these are non-productions cost, like C, salaries, rent, office expenses, depreciations, etc. C, step 4, uh, find net profit or loss, balance both sides. The difference is your net profit or net loss. Okay, now see the practical example of PL account. We continue our earlier example. From our earlier example, see gross profit, which is the difference of by balancing rupees 14,000 rent, salaries, commission received, office expenses. Let's see in PL account. See debit side, which is expense account, and credit side, which is incomes, all incomes. Okay, rent, salaries, office expenses, all are indirect expenses. Okay, and see this side gross profit, which comes from trading account 14,000, and commission received, which is indirect incomes. Okay, and by balancing the amount debit side and credit side, we found net profit. Okay, 6,000. It is the difference of debit side and credit side. See, here are some quick tips and mistakes to avoid while preparing trading and PL account. See, don't include indirect expenses in trading account. Okay, and don't forget to subtract returns from purchase or sales. Okay, and double check closing stock is entered correctly. And see the tips here. Uh, Always balance both sides of the accounts and understand the nature of each item first. It is expense or income. Okay. Let's see the importance of trading and PL account. Preparing these accounts help you to know, uh, are you making profits, which costs are high, okay, and lastly, how your business is doing overall. Let's start with the topic. What is a balance sheet? Uh, Balance sheet is a statement showing the financial positions of a business on a particular date. Okay, it helps us to find out. It shows what the business owns, means assets, and what it owes, means liabilities, and plus honors capital. Okay, the simple equations which is applied on balance sheet is assets is equal to liabilities plus capital. Let's see the format of a balance sheet. Okay, there are two common formats of balance sheet. Okay, see here, uh, horizontal account form type, capital and liabilities on left side, and in right side, assets. Okay, assets is included, and we have to balance the amount on lower. Okay, and see the second type, vertical, which is also called a report form type, on the upper side, capital and liabilities, and down assets, and we have to balance the amount. Okay, here and here, and we will use the horizontal format in today's video for simplicity. Let's see items that go in the balance sheet. Let's divide the items into sides. Okay, first liabilities and capital side. Here is capital, which included opening plus net profit, and we have to deduct drawings. Okay, and then loans, which include uh loan, bank loan, long-term borrowings. Okay, and lastly current liabilities, which includes creditors, outstanding expenses, and etc. Okay, and C, uh, other side, asset side. Okay, which include fixed assets, current assets, prepaid expenses, or accrued incomes. Okay, see here, fixed assets like building, machinery, furniture. Okay, like that. Now see the steps to prepare a balance sheet. Step 1, bring capital from trial balance. Okay, add net profit, bill, and less deduct drawings. Okay, and step 2, list liabilities like creditors, outstanding wages, loan payable. It's okay. See step 3, list fixed assets. Okay, add buildings, machinery, etc., like fixed assets, okay, and less depreciations expenses, okay. And step 4, add current assets, like cash, bank, closing stock, debtors, prepaid rent, etc. Okay, and lastly, check the totals by applying equations. Assets is equal to liabilities plus capital. Both sides should have to be matched. If not, recheck entries. Now let's see practical example of balance sheet. Here is given capital, net profit, drawings, creditors, loan, building, furniture, cash, debtors, closing stock. We have to find out which is assets or which is liabilities before applying into balance sheet. Okay, see here. Here is the balance sheet as on 31st March. Okay, uh, on left side liabilities and capital, and on right side assets. Okay, capital account is a capital, so we have included capital account. And opening capital, it is 40,000, so 40,000. And we have to add opening net profit in capital account. Okay, see here, add net profit. Okay, and less drawings, we have draw less drawings. And lastly, by balancing the amount, we have the amount 45,000 adjusted capital. Okay, all the liabilities, okay, is included on left side, liabilities and capital account, and on right side assets, building, furniture, debtors, cash, closing stock, all are assets. Okay, uh, by and lastly and lastly uh, we had balanced the amount. Okay, and see, 65,000 is the equal amount, so it is the correct. So here are some common error or mistakes people make while preparing a balance sheet. See, forgetting to adjust for drawings or net profit in capital. Okay, and second, posting amounts in the wrong side. Example, putting assets as liabilities. Okay, and lastly, missing adjustments like closing stock or outstanding expenses. Always double check and label your accounts clearly. Let's see why balance sheets matter. Okay, balance sheets can answer our questions like how much is the business worth. Okay, are we financially healthy? Can we pay our short-term liabilities? Okay, and what do we own versus what we owe? It's a key for investors, owners, and banks to assess business performance. Let's start with the topic. What are adjustments? Adjustments are the items that don't appear directly in the trial balance, okay, but need to be accounted for before preparing final accounts. Okay, see, they usually appear outside the trial balance, often in additional informations and affect two places in the final accounts. Okay, uh, we have already learned golden rule. Every adjustments affects two account. That is called the double effect. Okay, let's go over the top adjustments you must have to know. Okay, see, closing stock, outstanding expenses, prepaid expenses, acquired income, income received in advance, depreciations, bad debts and provisions for doubtful debts, and lastly, interest on capital and drawings. Let's now go through each one with examples and how they affect the trading, PL, or balance sheet. Okay, let's see the practical example of adjustments. First, closing stock. Uh, the closing stock is the value of goods left unsold at the end of the year, and the double effect of it in trading account, credit side, and balance sheet, asset side. Let's see the example. Closing stock rupees 10,000, and see the effects. Uh, so it so it on credit side of trading account and on the current assets in balance sheet. Okay, and us then see outstanding expenses, the expenses incurred but not yet paid. Okay, see double effect, add to related expenses in PL account. debit side, okay, and so on the liabilities in balance sheet. Okay, see the example: rent outstanding rupees 2000. Okay, add to rent account in PL account, which is expense, that's why debit side, and so 2000 on the balance sheet in liabilities. Okay, now example third, prepaid expenses paid in advance, but benefit will be received in the next year. Okay, see the total effect. Okay, deduct from expenses in PL and show under assets in balance sheet. Okay, see the example: prepaid insurance rupees 1000. See the effects: deduct from insurance in PL, okay, and show rupees 1000 under current assets. Okay, then C, acquired income, which the incomes earned but not yet received. Okay, see the double effect: add to income in PL account and show under assets in balance sheet. Okay, C, interest receivables rupees 500, and see the effects: add to interest income in PL and show rupees 500 under current assets of balance sheet. Now see the fifth adjustment, income received in advance. Okay, see the dollar effect: deduct from income in PL account. Okay, and show under liabilities in balance sheet. Okay, see examples: commission received in advance rupees 600. Okay, subtract from commission income in PL and show rupees 600 under current liabilities of balance sheet. Okay, and see sixth adjustment, depreciations. Okay, reductions in value of goods due to wear and tear. The double effect of these two adjustments: see, depreciations, okay, so as an expense in PL account, okay, and deduct from assets in balance sheet. See the example: depreciation on machinery rupees 2000. Okay, see the effects: so in PL, and deduct from machinery in balance sheet. Okay, on asset side. Now see the seventh adjustments: bad debts and provisions. First, bad debts. Bad debts are the amount that won't be recovered from customers, and the double effect will be PL account add to debit, add to bad debts. Okay, and in balance sheet deduct from debtors. Okay, deduct from debtors. And see, provisions for doubtful debts. It is the estimated future bad debts. Okay, double effect will be PL expense and balance it, deduct from debtors. And see the eighth adjustment, interest on capital and drawings. First, interest on capital. See the double effect: PL expense side, debit side. Okay, and balance sheet add to capital on capital and liability side. And lastly, interest on drawings. The all effect will be PL income side, credit side. Okay, and balance sheet deduct from capital on liabilities and capital side. Let's go over some mistakes people often make. Okay, ignoring the double effect rule. Okay, and putting adjustments only in one place, and confusing outstanding with prepaid, and lastly forgetting to adjust closing stock. Okay, so be careful. Okay, see, here is a super quick recap of adjustments and their effects: closing stock, trading account, credit side, and balance sheet, asset side, outstanding expenses, aid to PL, and also aid to liability. Okay, and debit expense, deduct from PL and aid to assets. Okay, then acquired income, aid to PL, and also in assets. Okay, and income received in advance, deduct from PL and aid to liability, here liability side. Okay, and lastly depreciations expense in PL, which is in debit side, and deduct from assets. Okay, and that's how adjustments work in final accounts. The key to presenting a true and fair view of business performance. Want a PDF summary or worksheet on this topic? Let me know in the comments. Don't forget to like, subscribe, and share this with your friends and classmates. See you in the next one, only here on Paper Coaching.